Welcome back. It's the Cash Flow Investor, and today we're diving into an essential topic for dividend investors: how to avoid yield traps. I'll explain what they are, why they're dangerous, and how you can avoid them to keep your portfolio safe and profitable. Now, before we get started, if you're passionate about maximizing your dividend income and want more of these insights, make sure to like and subscribe so you don't miss any of the new content. So first, we'll start by defining what a yield trap is. They come in many different forms and are not limited to individual stocks, ETFs, or REITs. They're usually high dividend yielders that may look appealing but carry higher risk that can be attributed to declining stock prices or unsustainable dividend payouts. So be wise. The entire point of dividend investing is to receive cash, but to have underlying assets that also grow. We want to make sure we're doing our due diligence to invest in only the best high yield dividend ETFs, stocks, or REITs. Don't fall in love with the yield and neglect other aspects of the investment. Research is absolutely crucial. So now let's get into why they're dangerous. And honestly, for me, there's three inherent risks that are present with high yield stocks. First one we will discuss is capital risk. This is especially important in covered call ETFs and businesses that have declining fundamentals. With covered calls, the risk lies in NAV, where the underlying stocks in which covered calls are being sold do not allow the investment to participate in the upside, since the calls are usually written at the money to gain the most amount of premium. This means they don't capture much of the upside move. A significant drop in high yield stock price will cause your overall portfolio to decline. We see this happen a ton in high yield stocks. One example is HBI, or Hanes Brands Incorporated. Although they had an attractive dividend, their stock price had seen substantial decreases until the eventual dividend cut, which leads to my next point. That as a dividend investor, you never want to hear the words dividend cuts. This is literally the final straw in what is otherwise known as a dying business. And the dividend cut is usually a result of becoming unsustainable due to various factors such as declining sales and poor management. Both of these leads to portfolio instability, which is another risk that you want to try to stay away from. This is an issue because as a dividend investor, you want to see that stable income and that consistent growth in your portfolio value. Getting trapped chasing yield reduces the effectiveness of a dividend-focused strategy and can lead to making poor decisions to make up losses. So now you might be wondering, what are some red flags that we should be looking for to stay away from yield traps? And there's a couple of ways to do this. You want to make sure that you pay attention to the high payout ratios. Dividends that exceed earnings or cash flow are usually unsustainable. You also want to pay attention to declining revenues. Businesses in decline are less likely to maintain a high yield long term and could signify the eventual dividend cut. You also want to look at high debt levels. Companies with high debt may struggle to maintain dividends when cash flow is directed to servicing debt. The more cash that needs to be sent to the debt, less cash it will be paying or able to pay out to shareholders. I also recommend just straight up looking at the stock chart and see the returns over the life of the ETF or stock. Is it stagnant? Does it trend up? Does it trend down? Sometimes being able to see where these stocks are on a chart can give you quick insight into how the stock moves, where you're purchasing, and if the opportunity of growth is present. I would also go and compare it to the underlying fund or its peers in this sector to ensure that it moves along with that specific market. Usually when you find outliers or things that don't really match up between the peers and underlying stocks in the sector, sometimes this can signify that something might be up with this specific company. One of the things that I really wanted to get into was analyzing QDTE as a potential yield trap. I'm seeing a lot of people talk about QDTE. This is a weekly paying covered call ETF, and this can be attractive for a lot of younger investors, especially investors that are looking for quick returns on their investment or cash flow on their investment, right? They're chasing yield, they want to invest, and they want to start getting that weekly money. So they're not necessarily get rich quick, but they're going about this the wrong way. So this ETF in question is a 0 day to expiration covered call ETF. Right? They seek to generate income each morning by selling out of the money 0 days to expiration calls on the index, which for them would be the QQQ. Keeping this in mind and understanding that this is a covered call ETF, we know that this fund will more than likely not experience the same capital appreciation as the QQQ. However, QDTE will participate in more of the downside risk as it holds the asset throughout the day. Since it's selling out of the money covered calls, it's going to be holding that underlying asset. And so if throughout the day the stock ends up going down, it's going to definitely participate because it's holding on to that. This to me presents an inherent risk that as the QQQ rises, because the premiums generated out of the money calls will have to be aggressive in order to generate some serious cash, it would limit the potential upside of QDTE to capture the upside move that the triple Qs are providing that day. So currently, QDTE has a dividend yield of 25.79% and distributes cash weekly. So like I said, young investors might see that and say, oh man, that's impressive. However, there is more to the story, and what I really want to draw to your attention is how the triple Qs and QDTE move. We won't have much info to go over since QDTE is a fairly new fund. However, we can look at the stock chart and we can see that on July 24th, the triple Qs had hit a brand new all-time high. However, QDTE barely got back up to its all-time high price of $46.54. Then again, after the recent run-up from the pullback, triple Q is breaking through all-time highs, yet QDTE is only at $43.68 and still 7% off its all-time high. So in my opinion, this stock is a typical case of capital risk. You're going to get that weekly payment, but that underlying cash that you put into and that you initially invested, it's going to be tough for it. Like, you have to go on an extreme bull run in order for you to get your portfolio back to the same level that it was before. So even though we would have been enjoying a nice income, that dividend wouldn't have increased throughout that time either. And we would have also had a sizable decline in our account value. So in my opinion, this is a yield trap. So I've mentioned some of the ways to avoid yield traps, right? We mentioned those above, but you can always head over to thebestdividendcalculator.com to do your own research and see how the dividend yield, expected growth rate, and capital appreciation can affect your portfolio. So now you know. You should keep in mind that these high yield stocks can, what they can and can't do for your portfolio. Each one is made different and has different factors that can affect your capital in different ways. If you found this video helpful, be sure to hit that like button and subscribe so you don't miss any of the new content. It's the Cash Flow Investor, and I'll catch y'all on the next one. Peace.